Can start.
Good evening to all the members who has enrolled for this session. Myself, CA Rekha Umarshi, Regional Council Member, SIRC. I take immense privilege in inviting you for all this session on FEMA Series. It is the second session on the FEMA Series. This is about foreign direct investment in India, including foreign direct investment. So this is one of the topics that is quite discussed these days with respect to what are the rules. Is there any approval required for foreign investment, whether we require the approval of government or RBI. So if you see for the past decade, there is an immense direct investment in India. Say for the sector, textile, automobiles, maybe it could be even railways, pharmaceutical, from all the industries, India has witnessed a significant flow as foreign investment. So today we have the speaker, PVR Rajendra Prasad sir. Welcome sir to the session. I take immense privilege in inviting him to the session. Sir is a fellow member with the Institute of Chartered Accountants India and has almost 36 years of experience as a chartered accountant. He is the founder and CEO of the PNP Consulting Limited. It is basically involved in international forex and business consulting firm, having offices in Hyderabad, Dubai, and even Singapore, and specializes in foreign investment consulting, foreign exchange regulations, and cross-border merger and acquisitions. So he has a wide exposure. He is the founder and managing director of the JPR Capital Private Limited, Category 1, SEBI registered merchant bank, and he is also the advisor of several MNCs clients in India and abroad, and on basically he is concentrating on structuring of inbound investments into India and structuring of outbound investments. He has also contributed many papers and delivered lectures on subjects of foreign exchange regulations in India and international finance at various forums in India and abroad, including ICAI, ICSI, and ICWA, and also at the Nalsar University and Singapore government programs. It's indeed an honor for me to invite you to the session.
Thank you very much. Thank you. Yeah, thank you very much, and good afternoon to all the erudite participants and organizers of this seminar. A generous introduction by CA Rekha Uma, and I think the topic given today is foreign investments into India, except for NRIs. That is what the organizers wanted, so we have removed the NRIs portion from the presentation, and we have also included the most confusing and which demands a lot of attention of chartered accountants, that is downstream investments, and why it demands a lot of attention, which we'll discuss as we get into the subject. So I think I'll share my screen. Yeah. So the topic which we will be discussing today evening for the next 3 hours, the foreign investments into India, as told by the CA Uma, lot of investments are coming into India, and especially some of the investments are from NRIs and some of the investments are from foreigners, and some of the investments are companies owned by foreigners as well as companies owned by NRIs. And also, as is usual, your reporting mechanism is not in pace with the inflow of the investments, and a lot of issues are there with respect to reporting. And also because they have come out with a firms portal that is also giving a lot of problems with respect to reporting. All these things we'll try to discuss as much as possible, but we'll try to get into the subject. And what I am planning to cover in my presentation is what is the policy framework for foreign investment, and what is the overview of the foreign investment, and we will discuss direct investments, which are in which entities can accept direct investment from outside India, and also we will discuss what are the downstream investments, which are indirect foreign investments, and we'll also look at briefly what are the portfolio investments, and if we are not able to access the automatic route, how to get approval from Government of India, and where we have to go go and submit our application, we'll very briefly discuss about government approval. So we'll first go ahead and discuss what is the policy framework of foreign investment, FDI investment into India, and what are the regulations which we have to go through before we take a decision with respect to any FEMA related query. I strongly suggest we all need to research, read, again research, and then only take a decision. As far as this FEMA inbound investment is concerned, all these regulations, law, policy comes into picture. One of the most important one is FDI policy, which is pronounced earlier on a twice a year basis, that has been made into a yearly basis. And now I think the latest one what we have is few years back, and that concept of bringing in FDI policy every year is deferred. But FDI policy is the key document for us to understand what are all the decisions government is taking with respect to the foreign investment inflow into the country, and which sectors they want to open, and what are all the related framework which they are designing for the regulator, in this case Reserve Bank of India, to administer the law. And we have also seen recently, some 3 years back, Reserve Bank of India used to issue notifications, which is the law with respect to foreign inbound investments, and by virtue of section 6(3) being replaced and repealed, and section 6(2)(a) has brought in, and they have transferred that power to Finance Ministry, and now Finance Ministry is issuing regulations in the form of rules, and the rules are called as Foreign Exchange Management Act Non-Debt Instrument rules. And the other things which we have to have a control on these regulations are FDI policy, which is issued by Ministry of Commerce, which is a policy document, press notes, press releases by RBI, FEMA Bear Act, which is a very small act having only some 49 sections, and FEMA rules issued by central government. Till now they have issued rules with respect to inbound investments. I think already draft rules for outbound investments are also in place, but they have not yet been officially announced, that it is still in the draft stage. And we have APDAR circulars. These are the circulars issued by Reserve Bank of India with respect to any decisions RBI takes, which will be immediately intimated to authorized dealers, and authorized dealers are obligated to bring the contents of these circulars to the constituents. Whether that is actually happening or not, that's what is written in every APDAR circular. And master directions. Master directions is nothing but an annual compendium of all the circulars issued by Reserve Bank of India. And also they would like to bring their mind out in those master directions. Whatever is missed out in the regulations, they try to keep it there. That is also one very important document we have to keep. So what I would like to present before you is, if we are reading one particular FEMA non-debt instrument rules, my humble suggestion to you is, you don't just stop there. You try to look around the related FDI policy, press notes given by the Ministry of Commerce as well as press releases by RBI, and then take a consolidated view on the issue which you are going to address or which you are going to research. So now coming back into what is the foreign investment overview. Foreign investment, the government of India has passed FDI policy. Based on the policy, earlier Reserve Bank of India has issued FEMA notification number 20, and that has been replaced by Foreign Exchange Management Non-Debt Instrument rules issued by Ministry of Finance. What in effect they are telling is, if there is any foreign investment coming into India, that is, I think you have already had other FEMA webinars where they have discussed about the basics of FEMA, and also person resident in India, person resident outside India. There, any person resident outside India is investing into the capital, or investing into the equity instruments, or investing into units of an investment vehicle. Any sort of security is going to be picked up by a non-resident Indian, then Foreign Exchange Management Act and this foreign investment regulations come into picture. As far as non-resident Indians are concerned, they were given a special dispensation where they can either invest with the repatriation benefits or invest without repatriation benefits. What we are discussing today is the investment by outside from a non-resident who is going to invest with repatriation benefits. We'll just briefly dwell upon what is the concept of this repatriation and non-repatriation. Repatriation is only with respect to capital and appreciation of the capital. As far as the income generated out of the investment, repatriation is always there. Like I will try to give a small example. If someone has invested, let's say, 1 crore of rupees in the shares of an Indian company, and if that Indian company is very good and declared a dividend of 10 crores, that 10 crores, whether that investment is made under repatriation or non-repatriation, always 10 crores after payment of taxes can be repatriated. All the issues, whenever we are talking about repatriation or non-repatriation, it is only with respect to the capital, and capital repatriation only is controlled. And now what we are going to discuss is how can a person resident outside India invest into the capital or capital instruments of an Indian entity which is allotting them, and where he is going to have repatriation benefits. Then another question comes, whether a person resident outside India, is he having an option to invest under repatriation or non-repatriation? That option is only given to non-resident Indians. Like an example, an American citizen of American origin, if he wants to invest under non-repatriation, that is not permitted under automatic route. He has to seek a prior approval from Reserve Bank of India, and the Reserve Bank of India in turn will have to take an approval from the government of India. So the concept of non-repatriation is only available to NRIs or having persons of Indian origin, or recently from 2016, they allowed entities owned and controlled by NRIs or persons of Indian origin, who are popularly called as OCI, Overseas Citizens of India. They are allowed. All others, other than these NRIs, OCAs, are entities owned and controlled by NRIs, OCAs, except these three categories. Rest of all categories have to invest under repatriation scheme, and such repatriation scheme is permitted through foreign exchange management non-debt instrument rules. As per those rules, the overview is they can invest. One is under automatic route, the other is under government route. In automatic route, direct investments can be made and portfolio investment also can be made. Whoever wants to make an investment and he is not falling into the conditions specified under automatic route, they can invest only with the prior approval of the government, and that is called as government route. And now we'll try to discuss what are all the regulations related to direct investments by persons resident outside India, including NRIs who wants to invest with repatriation. They fall in this sector, and they fall in this gamut where they have to comply with all these regulations. So we'll be looking at the investments into direct investments into company, and then we'll see LLP, then foreign venture capital investor, then into investment vehicles, and also we'll then see into downstream investments and what is all the complications involved there, how to get into that. All these things we'll discuss. But before we go into the subject, there are some definitions which I would like to discuss with you, and we all need to have a very clear understanding of it. So that will make this thing a bit easier to understand the intention of the legislator, and we can go deep down and find out what they are trying to put as a condition there. The first definition, these are all the definitions verbatim picked up from the law, neither a word added nor word removed. Foreign investment means any investment made by a person resident outside India on a repatriable basis in equity instruments of an Indian company or to the capital of a LLP. they have defined only up to this extent, but we can extend this definition also. If it is permitted to be invested in an alternative investment fund, they can also do it, provided they have the permission taken. But as far as foreign investment is concerned, the critical item which we have to take it into consideration is it made under repatriable basis? Then only it will be treated as foreign investment. If the investment is made under non-repatriation basis, that will be treated on par with the domestic investment. And they have given a small explanation. If anyone is holding the shares on behalf of a non-resident, as per the provisions of the Companies Act, such shareholding, even though the capital has been provided by the resident Indian citizen and held by the resident Indian citizen, that will be calculated for foreign investment. This calculation of foreign investment is of very significant importance as we go and look into the sectoral guidelines and also the percentages of investment permitted in certain sector, where this becomes very critical. Even a person resident in India holding on behalf of non-resident will be treated as a foreign investment only. And another important point, though they have added this point here, the whole concept of foreign direct investment was conveniently, what is foreign direct investment was not defined. From the day FEMA has been enacted and from which has come into operation from 1/6/2000, for a quite long time they have not defined what is FDI. Then FDI policy tried to define what is FDI, and they tried to define somewhere in 2015 through FDI policy, and later there was a confusion what is foreign direct investment and what is foreign portfolio investment. Then they have set up a committee under the chairmanship of Dr. Mayaram, Arvind Mayaram. And Arvind Mayaram, through the committee, they have given a report to government telling that what should be treated as FDI and what should be treated as FPI. We will see in our next definition what is FDI and what is FPI. But the concept what they are telling is, when any person is investing, any person resident outside India is investing as foreign direct investment in the same company, he cannot also invest as a foreign portfolio investor. Either he has to be an FDI investor or he has to be a foreign portfolio investor, but he cannot be both, which we'll appreciate if we look at the next definition. What is foreign direct investment? This definition, as we discussed, incorporated as per the suggestions given by Arvind Mayaram. FDI means investment through equity instruments by a person resident outside India in an unlisted Indian company. So if the investment is coming into unlisted Indian company, even one share allotted by a company, or the 1% capital issued by an LLP, or 1 unit allotted to a non-resident by an investment vehicle, they will become FDI if it is an unlisted company, or 10% or more of the post-issue paid-up capital on a fully diluted basis of a listed company. So here they brought in the change. If it is a listed company, a person can make investment either under portfolio, and as far as unlisted company, it is always an FDI. But in a listed company, there can be FPI as well as FDI, but the same investor cannot have both FDI as well as FPI. And they have given a way out in case an existing investment by a person resident outside India in equity investments of a listed company falls below the level of 10% of the post-issue paid-up capital, the investment shall continue to be treated as FDI. We have seen that 10% or more of a post-issue of a fully diluted base of a listed company, even in case where once it is treated as FDI, it is always treated as FDI. Once it is treated as FPI, it can become FDI or continue as FPI. And they explained the fully diluted basis means where there are instruments issued other than equity, which are having a convertibility of getting converted into equity at a future date. All those possible conversions have to be calculated upfront to decide how much FDI is there. As far as the convertibility is a compulsory convertibility. If there is an optional convertibility that has been made very clear by government that will not form part of the calculation. These issues we'll discuss when we are getting into downstream investments and indirect foreign investment there. Another important definition, a continuation of that, is foreign portfolio investment, which means any investment made by a person resident outside India through equity where such is less than 10% with a post-issue paid-up capital on a fully diluted basis. And they have come out with non-debt instruments when this concept, allotment of, this entire foreign investment under FEMA notification 20 has been shifted from Reserve Bank of India to Ministry of Finance. When they started issuing their rules, they have renamed the whole thing. Earlier, these things were called as capital instruments in the FEMA notification 20R. Now this Government of India Finance Ministry wanted to classify them as non-debt instruments and debt instruments. What are debt instruments? Whatever is not a non-debt instrument is a debt instrument. So we have to look at what are non-debt instruments. All equity investments in equity, public, private, listed, unlisted, capital participation LLP, all instruments of investment recognized in FDI policy, notified from time to time. Why they are telling this part notified time to time? Because they have some forward thinking. They brought some definitions, but what are those definitions? How we have to issue those things? Still, they have not yet clarified in the LDA regulations. But maybe they will be coming in future. We'll discuss later. Investment in units of alternative investment funds, real estate investment trust, and infrastructure investment trust, mutual funds, ETFs, which invest more than 50% in equity, and the junior most layer of the securitization structure. In any securitization structure, the junior most layer, which normally is around 5%, though it is a debt, that last 5% is the equity tranche, which will be recognized, which is recognized as non-debt instrument, and which forms part of the regulations of foreign exchange management, is non-debt instrument rules. And acquisition, sale, or dealing directly in immovable property. Why immovable property has come here? Because the government finance ministry thought earlier Reserve Bank of India issued two separate notifications, one for foreign investment by way of investment in the securities, and one notification exclusively for acquisition of immovable property in India by persons resident outside India. But as far as these NDI instruments, they clubbed both. It is only cut and paste. Whatever regulations were there, they just come and added those regulations here. And contribution to trust. Though how we can contribute to trust is not yet known. What are all the regulations with respect to that? They have not yet given, but they have first brought it under the definition of non-debt instruments, depository receipts issued against equity instruments, which we all know it is ADR, GDR. And another very important definition is equity instruments. Equity instruments is part of non-debt instruments. That is, equity instrument means equity shares, convertible debentures, preference shares, and share warrants issued by an Indian company, provided the equity shares are issued as per Companies Act, and they can be either fully paid or they have also brought in partly paid. The partly paid one, 25% has to come upfront. The balance has to be received within 18 months, and in case of warrants, which is in 12 months, it has to come. And in case of convertible debentures and preference shares, both have to be compulsorily, mandatorily convertible into equity shares. If there is any optionality given there with respect to conversion, then it loses the characteristic of an equity instrument and it becomes debt. If it becomes debt, it goes and falls in ECB guidelines, and the ECB guidelines are very seriously viewed by Reserve Bank of India. So one has to take care of only plain vanilla convertible debenture. As per the Companies Act, within 10 years it has to be converted into equity. So a convertible debenture can be issued, but that has to be fully and compulsorily convertible into equity shares. Another one is partly paid shares that have been issued to a person resident outside India shall be fully called up within 12 months of issue of such as specified by RBI from time to time. But 25% of the total consideration has to be received upfront at the time of issue. And in case of share warrants, at least 25% should be received upfront and balance can come in 18 months. And another important concept they brought in after this Startup India campaign has started, because all the instruments what we have seen are only equity shares, compulsorily convertible debentures and compulsorily convertible preference shares, but they have optionally convertible debenture or optionally convertible note which can be issued is given as a special dispensation to startups. Any startup which has been registered with government and they can issue a convertible note, an instrument issued by a startup acknowledging receipt of money initially as debt, repayable at the option of the holder. So this optionality clause has been given only for startups to issue or which is convertible into such number of equity shares of that company within a period not exceeding 5 years from the date of issue of convertible note upon occurrence of any events as they agree in the agreement. But one point is very clear here, they have made it very clear, a startup can issue a convertible note that will not be treated as an ECB, provided there are some guidelines issued that how much is the convertible note that can be issued, which we'll discuss later on. But it is an instrument they brought in for structuring with respect to startups, that it need not be directly equity, and the investor may be more comfortable issuing a convertible note, where if the company is doing well, he will have an option to convert into equity. If the company is not doing well, he is having a right to call back the money invested. That option has been given to startups to issue such type of convertible note. And another interesting thing, what I discussed earlier, that they brought in into the law, but they have not yet given any regulations with respect to that. That is this hybrid securities. They brought in this concept of hybrid securities in the definition. Hybrid instruments such as optionally or partially convertible preference shares or debentures and other such instruments as specified by central government from time to time, which can be issued by an Indian company or a trust. They also added a trust here, and to a person resident outside India, but they have not come out with any regulations of allotment of hybrid securities, how they can be allotted, what are all the regulations connected with that. They have not yet come. But this only implies that it may be coming very near, in the near future. We may have also an option of advising clients with respect to hybrid instruments. Now let us go one by one. Let us get into what are all the conditions with respect to direct investments into a company. Reserve Bank, the Government of India Finance Ministry has given general permission to Indian companies to issue equity instruments to a person resident outside India without prior approval, subject to compliance of conditions prescribed in Schedule 1. These non-debt instruments rules are having Schedule 1. Schedule 1 is the crux of the law, which gives the permission to a person resident outside India to contribute or acquire the shares of an Indian company, and it also gives a permission to a company in India to allot shares to non-resident, subject to compliance with the conditions. And earlier this was popularly called as FDI scheme. That is what is the name they have given in FEMA notification 20R. Now that name is not there in NDA regulations, and it is a FDI scheme, is the scheme through which a person resident outside India is permitted. But what I would like to bring a point to your notice is, in the same NDA regulations, there will always be one regulation 3 popularly, or regulation 3 or 4. In case of outbound investment, it is regulation 5, which states, save as otherwise provided, no person resident outside India can invest. So they are putting a blanket ban that no person is permitted to invest in India, save as otherwise provided. So what is otherwise provided has to be complied to the last letter. Because if there is a simple non-compliance, regulation 3 or the relevant regulation gets attracted. So this is one thing we have to keep it always in mind. And this has given permission not only for non-residents to invest, this has given permission to resident Indian companies to allot shares to the non-residents, or in case of transfer of shares, record in their register of members regarding transfer of shares from resident to non-residents. We were telling about automatic route and government route. What is automatic route? Automatic route means entry route through which investment by a person resident outside India does not require prior approval of either RBI or central government. And conversely, government rule means it requires a prior approval of the government. Then whenever we are telling automatic route means it is permitted, provided, complying with all the conditions what we are going to discuss. Then prior approval of RBI is not required, or government is not required. Any of the conditions are non-compliable, then we have to go to government, seek a prior approval, then only investment can be brought in into the company. Having given the permission for non-residents to invest in India, there are some sectors, they said they are totally prohibited, where FDI is not permitted at all, or foreign investment is not permitted. One is lottery business, including government or private lottery, online lotteries, they have put etc. Etc. is a very dangerous word. What is that etc? Nobody knows. But we have to assume anything connected, either directly upward integration or downward integration, to the extent the main activity is conducted, such a type of a business is not permitted. Gambling and betting, including casinos, etc., not permitted. Chit funds are not permitted. But chit fund part, becoming a member in a chit fund, Reserve Bank of India has given a permission to non-resident Indians to become chit members. But the permission is not given for a non-resident to become a shareholder in a chit company or to become a partner in an LLP which is running chits. That is not given, but they have given permission only to the extent of participating as a chit member. Nidhi company and trading in transferable development rights. These transferable development rights are rights given by government when they acquire a land. They give a development right which is not permitted to be transferred by way of trading. In such trading, any non-resident investment is prohibited. And the next and most important and complicated definition, which is confused several times, is real estate business. Real estate business is prohibited. But what is real estate business? They said real estate business shall not include development of townships, construction of residential or commercial premises, roads or bridges, and real estate investment trusts registered and regulated under SEBI REIT's regulation 2014. But having said that, real estate which is purchased and sold as a speculative trade by non-residents is classified as business. But whereas there is a conspicuous development that is taking place, in such development, a non-resident can become a shareholder, or a foreign investor can become a foreign shareholder, a foreign investor of foreign origin can become a shareholder. But if their intent is only buying and selling without any development, that will be reckoned as a real estate business, and that is prohibited sector where no FDI can be permitted. Sorry. Manufacturing of cigars and cigarettes of tobacco or tobacco substitutes not permitted, and activities or sectors not open to private sector. Some of the examples are atomic energy, railway operations, other than permitted activities. Education is not permitted. There also education is, because as per the law of this country, wherever the education, an institution is giving education which leads to certification by government, like a 10th standard or intermediate, +2 or degree, all these things come and fall within the guidelines of the Ministry of Education. And as per those guidelines, where the education which is having a the educational institution which is giving them a degree which is to be approved by the government. Such a type of educational institutions cannot run on a profit mode. They have to run only as a non-profit mode. A very good objective of the government, and we all know how much money education institutions are making. Be that as it may, as per the law, any school which is giving education up to 10th standard, or which is giving up to 10 plus 2, or a college giving any education which is giving the degree certificate or master certificate, all have to run under a society or a trust, and such a society trust has to be formed as a non-profit making institution. Into that institution, for because the investment into trust, investment into society is not yet permitted. We have seen there are definitions given, but still the regulations with respect to investment in a trust or investment in a society is not permitted. The only exception they have given for a trust is a venture capital fund organized in the form of a trust with the approval of the SEBI is an entity where the foreign investment is flowing. Other than that, no other trust can have a foreign investment flow into it with the repatriation benefits. And so the education sector also is having a lot of issues and a lot of complications were not there. It's better you all do a research with respect to the private sector investment, which are not permitted. Activities are not open for private sector investment. That we have to be careful. And another thing is, in any of these prohibited sectors, if any foreign collaboration in any form, or you want licensing of franchise, management contract, or anything for lottery business, gambling and betting activities are not permitted. Even because some people, some companies in India are still doing this betting and gambling in the fond hope that, like playing of cards, Supreme Court in one decision has said playing of board is not a chance game and it is a mind activity. So like that they are doing. There are some states in India, they banned everything. So in those states they are not doing, but in these states they are doing. It is always advisable to take the prior government approval when such type of investments are flowing into, because any type of investment is regulated and prohibited. Then let us look who can invest in India. A person resident outside India or an entity incorporated outside India can invest. So please remember this, an entity, if it is going to invest, it has to be either incorporated, though they have not written in this particular regulation, elsewhere they have agreed, registered, either incorporated or registered entity or a person resident outside India only can invest. So that makes it very clear, unincorporated, unregistered entities cannot become foreign investment persons making investment in the Indian companies. This is one point we have to take care. That should be the checklist number one, whether the investor is an incorporated entity, if it is an entity. Then they have given some exceptions. An entity of a country which shares a land border with India. This has come after this Corona has come into effect, and Corona has shaken the entire world. At that time, every country started becoming introvert, and foreign exchange, whatever capital control regulations we are having, most of the developed countries also have started implementing these capital controls. Now the era of liberalization, globalization is slowly going back, and most of the countries have brought in regulations where they are trying to control by bringing in by whatever name called. Some are calling it as investment law, some are calling it as some other law. Here, what we have done when Corona has affected, this is the rule they brought in: an entity of a country which shares a land border with India, or where the beneficial owner of an investment into India is situated in, or is a citizen of any such country, can invest only with the prior approval, and he cannot come under automatic rule. So who shares the land border with us? Pakistan, China, and all these land border countries, Bangladesh. You need to have prior government approval. They said, and one more rule which is there right from the beginning is citizen of Pakistan or an entity incorporated in Pakistan can invest only under government rule in sector activities other than defense, space, atomic energy, and sectors prohibited for foreign investment. But I think that here we need to understand the difference between point 2, what we discussed here, and point 3. Citizen of Pakistan or an entity incorporated in Pakistan is not permitted to invest. It requires government approval. But having said that, if a citizen of Pakistan is holding 100% shares in a company in London company can invest under automatic route earlier. When the second point, that an entity of a country which shares land border in India or where the beneficial owner of an investment to India is situated in, or is the citizen of any such country, can invest only. Here they try to lock that door also. That trying to come as investment indirectly through some other source also is blocked from 2019 when they have brought in this regulation. And also they said, in the event of transfer of ownership of an existing or future ODI in an entity in India, directly or indirectly resulting in beneficial ownership, falling within the restrictions we have discussed above, such a subsequent change in benefit will also require government approval. What they want to tell is, not only at the time of investment, not only they're acquiring shares now, after acquiring shares, if the investment is getting transferred, the ownership is getting transferred there, then also it requires government approval, or they're taking the existing shares also required ownership, government approval. And this is the point which has become very critical, which we have to keep it in mind, because that becomes automatically a contravention if we are not doing due diligence where from the investor is coming and who are the ultimate beneficiary owners. All these things have to be checked. Then only he will become a person eligible to invest in India. OCBs, overseas corporate bodies, used to be there till 2003. They were de-recognized, and from 2016, the government has brought in under Schedule 4 a regulation wherein a company owned by sorry.
Yes, sir. Desktop screen got changed, sir.
Yeah, just sorry, 1 second.
Yeah.
Yes.
Yeah, now it's just.
Yeah, sorry. So indirectly OCBs were de-recognized, but from 16th September 2016, 16 September 2003, they de-recognized. Somewhere in 2016, they brought in again a law where a trust company, partnership firm incorporated outside, owned and controlled by NRI OCS, again permitted to invest only under non-repatriation basis. This is a special dispensation given. This also is very important law, which you can discuss, which will help in structuring, because if it becomes a company under non-repatriation, structures will be more convenient in certain circumstances. And another one is foreign portfolio investor, foreign venture capital investors. These are the people who are permitted to invest under foreign direct investment scheme, erstwhile called as, and now under non-direct, non-debt instrument regulations. These are what are permitted. Now let us quickly get into what are all the conditions we have to see when a company is planning to get the investment. The condition number 1 is, we have to check what is the activity this company is doing. What is the primary activity this company is doing? And also, even if there is a small activity which is forming part of 1% of its revenue also, that activity also will be attracted by the sectoral caps. The law has given 17 sectors in Schedule 1. In those 17 sectors, the law made it clear each sector how much a non-resident can invest, and whether it can be invested under automatic rule or it can be invested under government rule, and what is the limit of investment. All these things have been specified. So the first step we have to do whenever a company is planning to take the investment, we have to check up whether the company's activities include any of these 17 sectors. One popular question is, if suppose the company is having in its memorandum and articles of association an activity which is in one of these 17 sectors, but that activity that company is not doing presently, whether it can accept, if suppose such activity requires government approval and the company in fact is not doing any business with respect to that activity, can it accept? No. If the company wants to accept equity, foreign equity, and such activity is mentioned in the memorandum and article, step number 1 is that memorandum and articles has to be altered, that activity has to be removed, then only automatic route is possible. Otherwise, you have to go through, one has to go through the government approval too. And they have given 17 sectors. I have not put here the entire list of 70. These are all available in the NDA regulation. In these 17 sectors, they have given entry route and they have given investment up to which level it can be done, and what are all the conditions attached there. And these conditions are called FDA. There are some FDA linked performance conditions. They have defined what is FDA linked performance condition means. In one particular sector, the government might have put certain conditions, like say earlier in construction sector, they have put conditions that the minimum investment that has to come is $5 million. The minimum investment that has to come if it is a wholly owned subsidiary is $10 million. And they have put another performance conditions, like if a foreign investor is investing in real estate development sector, then the activity, then the project should be completed within a period of 3 years. If it is not getting completed in a period of 3 years, what has to be done? These are all issues where performance conditions were mentioned, as well as equity, how much minimum capitalization they have to bring. That they are the ones people used to think those are the FDA linked performance conditions. But now in the NDA regulations, they said FDA linked performance conditions means any condition written in against those 17 sectors. If you look at the 17 sectors in the NDA Schedule 1, every sector is having a condition except a few sectors like manufacturing, where there are no conditions written there. Because the definition they have defined, FDA linked performance conditions means any conditions mentioned in the Schedule 1 with respect to those 17 sectors, every sector is having a condition. Why this FDA linked performance conditions is important, which we will discuss in the coming slides. But we have to understand, we have to go through the 17 sectors, go through the conditions there, and whether it is applicable to the present company which is accepting, we have to see. Then you have to decide whether it is automatic route or permission. And foreign investment in financial services, this is one very important sector. That is the last sector defined in the 17th sector, which is numbered as number F. They have given various sectors there, and what they have mentioned clearly there is, whatever is not mentioned there in that number F sector, and which is not registered and which is not controlled by any financial regulator like RBI, SEBI, IRDA, or any other future markets commission. If any of these financial regulators are not regulating, such a type of a company which is in financial service sector requires government approval to accept foreign investment. This is one again I am repeating it and requesting all of you to look at number F and read all the conditions there very carefully. And because this is one common mistake committed, I'll tell a small example where if someone is setting up a management consultancy, where one of the objective of management consultancy is to provide like a financial consultancy, like raising a loan for the client and helping him in raising the loan. Whether helping a client in raising the loan, will it fall under financial services sector? I may say yes, somebody may say no, and this argument goes on. So in that number F, they made it very clear. If you are not clear whether it falls in financial service sector or not, even then you come for government approval, don't go under automatic. Once we, for the companies which have gone for government approval, what they have stipulated conditions are, if you are not controlled by any financial regulator into financial service sector, the minimum capitalization is 20 million US dollars. That has to come be invested, then only the government is giving permission for that. This is one area, please be careful. And then let us also look at what are the other minimum important conditions. Somewhere in that, those 17 sectors, it will be telling what is the minimum capitalization they have to bring in. Like one sector, which I'll give you an example, is like multi-brand retail trading. Multi-brand retail trading, if you want to accept investment from non-residents, then the minimum capitalization has to be $100 million. So whether that $100 million has to come into the company accounts, that's what they are making it clear as a condition, that whenever we are telling that there is a minimum capitalization, that minimum capitalization amount should come into the account of the company. If the shares are transferred by existing shareholders to this incoming foreign investor, and the amount is received by the departing, shareholder who is selling the shares, such amount paid to the selling shareholder will not be reckoned for minimum capitalization. Unless company only direct issue at that time, then the capitalization is only reckoned to the extent of face value. If the company is allotting shares with the premium, the entire amount will be reckoned as minimum capitalization. And another point, they made it very clear, this is also very important. If the company is having the only objective as investing in other companies, but it has not registered with as an NBFC or CIC, that type of companies, because it is an investing company, because it falls under financial services sector, and because it is not regulated by any financial regulator, that requires a prior government approval to receive the foreign investment. Then what happens to if there is a company which is not having any activities, but which is interested in making investment in other sectors, and also it is interested in doing some operation, that we'll see in the next slide. As far as investing companies which are not registered as NBFC, CIC, requires prior government approval, and also RBI, these rules have clarified, NBFCs registered with RBI can receive up to 100% foreign direct investment under automatic route. Why I am telling this here specifically is, if you look at that sector F, NBFC will not be there anywhere. For that, you have to look at the other conditions. There they made it very clear, if it is a regulated entity of RBI, it can receive up to 100% FDI, subject to the condition, if RBI, while giving the permission, approval or registration, if they have imposed some conditions with respect to non-resident investments, they will prevail. Otherwise, 100% FDI is permitted. And we'll see what we discussed earlier. The same one, an Indian company, any Indian company which is not having any operations, but set up to undertake some activities, not only investing in the other company, it has set up to do some activities which are under automatic route and without FDI linked performance conditions, and has not made any downstream investment that is treated as indirect foreign investment for the investee company, can receive foreign investment under automatic. So they tried their best to confuse everyone. What their intention is, if there is any Indian company which is not doing any activities, then in their memorandum and articles, it should be very clear that it is going to embark on conducting activities which are under automatic route, and there are no FDI linked performance conditions, because we have already discussed what is this FDI linked performance conditions means. Some conditions mentioned against the sector. Suppose we are talking about real estate development. Real estate development are having a lot of conditions. which will be viewed as an FDI linked performance condition, then such real estate activity company not doing any operations but having in its memorandum to go into real estate activity, and if such company has not made any investments in another company in India, real estate company cannot receive. If the same example, if we replace real estate company with a software development company, it will fit into the example. It can receive foreign investment under automatic route, even though it is a software company, just set up, not doing any activities, not made any downstream investments, but not having any FDI linked performance conditions, because software sector is not having any FDI linked performance conditions, because that 17 sectors, whatever are mentioned there, those sectors they have mentioned what are the limits. For all the sectors what are not there in the 17 sectors and which are not forming part of prohibited sectors, 100% foreign investment is permitted under automatic route without any FDI linked performance conditions. So one such sector, because software is not in the 17 sector, software is not in the prohibited sector, that forms as an automatic route 100%, and FDI linked performance conditions are not there, it can accept. So this point also is very important if you are planning to structure any foreign investment into India. This type of structure also is possible. And another important condition is who is responsible if there is any contravention with all these regulations, what we discussed or what we are going to discuss. The entire onus of compliance is put on the company in India receiving the foreign investment. And also they have brought in one more point in FEMA 20R itself, it has come, and which is also there in NDA regulation. If any foreign investor while making investment specifies that in the shareholders agreement that such particular audit firm only has to be appointed, which normally we see when a foreign investors coming, they will be telling that so and so XYZ firm only has to be invested. Then the law is telling in whenever such type of a condition is forming part of the shareholders agreement, then the audit has to be conducted compulsorily as a joint audit, wherein one of the auditor should not form part of the auditor or auditor group or network specified by the foreign investor. So the government intention is, they are telling only get it done from XYZ, they say no, along with XYZ, there has to be another auditor who is not having any link with that auditor, is what the decision they have taken with respect to audit if there is any insistence from the foreign investor. So we have seen what are all the sectors, how the money can come inside into the company. Then we have to look at how the money has to be received by the company. The mode of payment by non-resident investor, the amount of consideration shall be paid as inward remittance from abroad through normal banking channels or from out of funds held in NRI in case of an NRI, or OCI, FCNRB is a deposit account, or if they have opened an escrow account, for escrow account opening permissions are also given in the FEMA regulations. If a foreign investor wants to acquire shares of an Indian company, and while acquiring such shares, it may quite be possible that there cannot be a situation where immediately we give money and the company allots the share. There may be a lot of negotiations going on, and one of the negotiation points from the Indian seller side is they may ask non-resident, first you bring money and then we will decide about allotment of shares. We want to be certain that the money is there. In such scenario and various other requirements, an escrow account may be opened. If such escrow account is opened, it has to be opened with an Indian banker as per the FEMA regulations concerning the opening of the escrow account. If that is done either from such escrow account or from outside India as a normal banking through normal banking channels as an inward remittance, or it has to come from NRI or FCNRB. Only these are the modes. They have given some special exemptions where the mode of payment, even without receiving money, when we can allot shares, those are the exceptions we'll see. But if it is not falling in those exemptions, always money has to come. Only against that money, the shares have to be allotted. If the shares are not allotted and later the money is remitted, that becomes a contribution. Anyway, the Companies Act will not permit it. But with respect to LLPs, also this is very important. And the money has to first come in, then only shares have to be allotted. And we all know equity instruments have to be issued even under Companies Act within 60 days from the date of receipt. Otherwise, they made in the NDA regulations, they brought clarity. If suppose by any reason within 60 days or shares are not allotted, they have given another 15-day period within which the refund has to be completed. Earlier, this was also not there, and we all used to have problem how to refund it back within the 60 days. So we have to take a call on the 50th day itself whether to allot the shares or refund it. They have given another 15 days time. In case of partly paid share, the period of 60 days shall be reckoned from the date of receipt of each call payment. Then we will see what are the exemptions given for receiving the money by the company, under what circumstances we can allot shares, though we have not received remittance into the company. Number one is any funds payable by a company to a foreign investor, provided such payable is in compliance with regulations or does not require prior RBI or government approval, then they have given a fantastic leeway where if the person, the creditor is acceptable to take shares in lieu of payment, and the company is also willing to allot fresh shares in lieu of payment, then that can be done. But the most important point is such payable should be in compliance with the regulation. So let us take what could be the payables to a foreign person by a company resident in India. A company resident in India might have taken either services or might have taken goods from him as an imports, or either imported service or imported goods. In one of these instances only where they may be obligated to allot shares. The third one is they might have taken a loan in compliance with the FEMA regulations, which is external commercial borrowing, or they might have taken a trade credit in compliance with the FEMA regulation. In all these circumstances, if the loan is as per the extant regulations, like let us take one example. If suppose they have imported some equipment, as per law, when any item, physical goods or services are imported, within 180 days, the amounts have to be paid. If the amounts are not paid within 180 days, this will automatically become a trade credit if it is more than 180 days, and if it is more than 3 years. For a capital goods, it will become an external commercial borrowing. But the law has told, because of certain financial difficulties or some other problems, if the company in India which has imported is not in a position to pay within 180 days, if they want to pay after 180 days, the Reserve Bank of India directed bank, you allow that remittance to go. But the authorized dealer banker is always having a right to seek the prior approval of RBI if he is having any doubt with respect to the goods imported and the delay in the payment. They can delay the matter, they may refer the matter to RBI. But what this regulation is telling is, if such payment is due and it is within that 180 days, which doesn't require approval of RBI or authorized dealer or anyone or government, such a type of payables only can be converted. If suppose there is an external commercial borrowing which is taken for a 10-year period, 3 years are completed, the balance amount is so much is still due and payable, there are no non-compliances in the ECB, then they can go ahead and convert the shares into equity, provided it is mutually agreed between the Indian company and the lender. This is one exemption they have given from FEMA 20R itself. The same thing is continued here. And the next one is where there will not be any inflow of funds, only where the mode of payment is not coming by way of inward remittance, and this is settled against the payable. And another one is an Indian company may issue equity instrument which is engaged in automatic route sector. Luckily, they have not put FDA linked performance conditions. It is only automatic route sector. It should be under automatic route. It should not be under government route. Then it can swap of equity instruments is permitted. But when we are talking about swapping of equity instruments, swapPing of equity instrument happens when an Indian company is allotting its shares to a non-resident, and in turn, the Indian company should be acquiring equity instruments outside India. Then only it is called swap. And such a type of a swap, earlier, right from beginning, that is from the year 2000 when FEMA came till around 2004 or 2007, I'm not there, till such time, only in outbound investments they have given permission to go to FIBB and take permission, and again we have to go to FIBB for getting FDA for non-realization of money and against import, against equities acquisition outside. This two-leg transactions used to require two separate permission. From that scenario, it has come where in the outbound investments they have given general permission, but for the inbound investment they have not given the general permission. That is, a company in India can acquire shares as a swap outside India. That permission was given earlier in FEMA notification 120. But for the Indian company to allot shares and non-receipt of foreign investment by way of remittance into India, for that FIBB permission was required. That also has been now dispensed with. As on today, swap of equity instruments, outbound leg 120 is giving the permission, inbound leg, now this non-debt instrument regulations are giving the permission. For both the legs it is permitted, provided the swap of equity instruments is provided, it is complying with all the conditions what we have discussed earlier. The investor should be an eligible investor, and we will also see the pricing guidelines afterwards. And also the activity what the company is doing should be under automatic, and all these things, and also it should be within the limit. Otherwise, by acquiring, by taking a government approval only, that can be done. If it is complying with the automatic route sector, swap of equity instruments is permitted, and which is now becoming a very popular model. And also it requires a lot of research by all of us to get into and make it more and more compliant when the transaction is being conducted. Another one is import of capital goods or machinery or equipment, but second-hand machinery or capital goods are not permitted. First-hand one, once you import, the key important point there is within 180 days, this whole concept of allotment of shares, everything has to be completed. Otherwise, if it is beyond 180 days, or in case of payables also, if it is beyond 180 days, we have to go to RBI and take the necessary approval. And if such approval is given, along subject to compounding, the compounding also should be completed, and then only the swapping or allotment of shares against capital goods or allotment of shares against payable is possible. When there is any regulatory issue involved that has to be fully completed, then they are also given permission for pre-operative or pre-incorporation expenses incurred, certified by the statutory auditor, without any limit. They have given in case of a company which is not a wholly owned subsidiary. If suppose a US company has set up a wholly owned subsidiary company in India, and against that company wants to allot towards pre-operative and pre-incorporation expenses, there is a separate guideline for that. See, if it is not a wholly owned subsidiary, then this rule will apply. They can allot for pre-operative or pre-incorporation expenses. Against that, shares can be allotted. Suppose if it is a wholly owned subsidiary that is set up by a non-resident entity, and then that entity should be operating in a sector where there is 100% automatic route, and they have also linked this FDA linked performance conditions. We have seen it earlier, this FDA linked performance conditions are there, and now they have linked as far as the relationship is WOS and the parent. If that is the case, the government is telling, hey, wait, if you want to allot share, restrict it to 5% of the authorized capital, or you equivalent to 500,000 USD, whichever is less, subject to the condition that reporting shall be done of the transaction in the firm's portal within 30 days of allotment, but not later than 1 year from the date of incorporation of the company. So these two are again the yardsticks. If these two yardsticks are crossed, again we have to go to RBI or government for approval. So the firm's portal uploading, we'll discuss later on, that has to be done within 30 days from the date of allotment. Such a date of allotment also should be well within 1 year from the date of incorporation of the company. Once the date of incorporation of the company 1 year is over, then this allotment of shares against pre-incorporation is not possible. And also it should be done in such a way that immediately within 30 days allotment is possible, and that 1 year incorporation date also is complied with. Then this is a permission they have given for WS. Then the most important one, the pricing guidelines, which are all very, very important for all of us as chartered accountants. What are the pricing guidelines which we have to follow for whenever these direct investments are made by non-resident? The equity instrument shall be issued as per the following valuation norms issued and shall not be less than the price worked out in case of a listed company as per SEBI guidelines, in case of a company in delisting process as per SEBI delisting equity regulations 2009, in case of unlisted company, valuation done as per internationally accepted pricing methodology for valuation on an arm's length basis, duly certified by a chartered accountant or merchant banker or practicing cost accountant. This is the requirement of FEMA. But there can be a requirement of income tax differently if it is an unlisted company, and the shares have to be valued on a discounted cash flow method, which is an internationally accepted methodology. Then as per, I think, income tax regulations, only valuation of merchant banker is permitted, whereas here it can be either a chartered accountant or merchant banker. So here the small piece of advice, humble advice is try to take merchant banker valuation only for both, because if there is any difference in the valuation, that is being questioned both by income tax as well as Reserve Bank of India. That is number one. Number two, the law is telling the minimum, it should not be the price, the value for which the share is allotted should not be less than this price, because the word used less than, lot of people, lot of companies started allotting at a much higher price. Even if you issue at a much higher price, that will lead to investigation by EDs. Several companies have gone through the investigation. So it is always advisable to advise the client, if the investment is taking place, it has to be as near as possible to the valuation. If suppose the valuation is done at 100 rupees per share and acquisition is done at 500 rupees, as per the law, we may think it is complying, but that gives enough room for the ED to start investigation. Why the company valued at 100 rupees is acquired for 500 rupees. Then the ED in several cases started questioning that it is your own money parked outside is coming into India at that valuation, which becomes very difficult to convince, because when the valuation is 100, on what basis 500 rupees has been paid. So that is one important point you have to keep in mind. And the next one is the most important, and where the client will be requesting us to take care if the chartered accountant is going through, that is reporting. In case of equity shares, the reporting has to be done by filing a firm's portal. But in case of convertible instruments, where they have issued compulsorily convertible shares or compulsorily convertible preference shares, the price or conversion formula should be determined upfront at the time of issue of the instrument. This is very, very important. You may not be allotting shares. You may be the company, you in the sense the company may be issuing a compulsorily convertible debenture. Companies Act, Income Tax Act may be treating it as a debenture, but FEMA will be treating it as equity. They want to know on the date of allotment of this instrument, which is convertible, this instrument after conversion will become how many shares at what price. That should be determined upfront, and the price at the time of conversion, if you want to increase, you can increase, but you cannot reduce more than reduce beyond the fair value worked out at the time of issuance. These are also very popular contraventions committed, sir. These you need to be very clear about. Then now the reporting requirements. Indian company has to first create an entity master in the RBI firms portal whenever it is planning to get any foreign investment. First you go and create well in advance. If the investment is going to flow in after 30 days or 60 days, nothing wrong in creating a firms portal, telling, and in the portal you have to tell what is your shareholding structure of the company as on the date of creation of the entity master. As and when the foreign investment comes in, these changes can be made. And all these, and also a business user has to be registered in the firm's portal. Such business user can interact through firm's portal. Form FCGPR has to be uploaded in the firm's portal within 30 days from the date of allotment. Please be careful. All these computer portals of government, either income tax or GST or this RBI, are not really so fast and efficient. Sometimes they totally shut down. So it is always advisable, if the 30 days is the period, don't try to attempt to do it in the last day. Even if we say it is your firm's portal, they will be levying that late submission fee. In some cases, they will be referring it to the compounding. Better to do it well in advance. And another important point is, if one FCGPR is filed or any other relevant form is uploaded, the next form cannot be uploaded unless the fate of the first form is finalized either as an approved or rejected. Till such time, the second form cannot be filed. This is one practical issue. So you try to advise the client to structure the investments in such a way that there will not be any non-compliances. So enough time is given, and FCGPR or any other form or form LLP or FCTRS, once it is filed, unless that is sorted out, the next form will not be taken by the system. There is also foreign assets and liabilities form that has to be filed by every company which has received foreign investment on RBI FLAIR portal before 15th day of July every year, so long as the investment continues. And there are a lot of practical issues with respect to this FCGPR filing. And if, I don't want to take a lot of time on that, because we'll again miss out on time dealing with the other issues. The next issue we have to do is rights issue and bonus issue. Whether rights or bonus can be allotted to non-resident, yes, provided they are holding shares in the company as per the extant FEMA guidelines. Like when they have made investment, that FCGPR should have been filed and FCGPR should have been approved. Then only it will be construed as the shares are held as per the extant regulation. Suppose an investor is buying shares from an existing resident, existing shares from a resident, FCTRS should have been filed, that should have been approved. And the rights issue and bonus issue, anyway, bonus will not breach, rights issue should not breach the sectoral caps. In case of listed companies, price of the shares can be determined by the company. In case of unlisted company, the price shall not be less than the price offered to persons resident in India. This has been thoroughly misused by several people, because this is one way of getting the foreign investment into India at a price comfortable for the company and the investor. This RBI and government have locked that in respect of resident renouncing shares to a non-resident, then that such a non-resident can only be allotted share at the pricing guidelines applied, not at the price offered to the persons resident in India. This was a structure several people tried to use it, not taking it away from the valuation norms. In case of a company where the valuation of a share is 500 rupees, if it is valued by a merchant banker or chartered accountant, but if this company wants to allot shares only at 100 rupees, then they used to give come out with a rights issue and offer the shares to the residents at 100 and renounce the shares to non-resident, and non-resident also becomes eligible to invest only at 100 rupees. That has been now dispensed with, that they have to comply with the pricing. ESOPs also, any Indian company subject to sectoral caps may issue ESOP or sweat equity shares to its employees, directors, or employees or directors of its holding, overseas joint venture, overseas wholly owned subsidiary or subsidiary who are resident outside India. The scheme, if it is listed as per SEBI, if it is an unlisted company as per company share capital debenture rules, and allotment to citizens of Pakistan, Bangladesh require prior government approval. Only important point here is, if the ESOPs are allotted at the time of issue of option itself, farm ESOP has to be filed within 30 days. It has got nothing to do with the allotment, vesting or anything. Whenever a grant has been issued, the option is issued to a employee or director, whether he has vested it or not vested it, when the option is given, within 30 days ESOP has to be filed. And whenever the options are all completed, where the company allots the shares, within 30 days Form FCGPR has to be filed. These are the two important points in ESOP, and also the scheme has to be in compliance with SEBI or companies that share capital and debentures rules. And convertible note, which we have discussed earlier, where the convertible note by an Indian startup company he can issue. This is one where special dispensation given to a startup company where they can accept as a convertible investment. That means they can take it as a loan and they can repay it as a loan, or they can convert it into equity at the option of the investor. This is only given to startup company which is registered with the government as a startup, and they can accept from all non-resident investors except citizens and entities registered or incorporated in Pakistan and Bangladesh. And the minimum investment for this convertible note has to be 25 lakhs or more in each tranche. There is no upper limit, but the limit cannot be, each single tranche cannot be less than 25 lakh. And this Form CN has to be filed through Farms portal. Anything filed through Farms portal is only through authorized dealer. First it will go to authorized dealer, from there only it will go to RBI. In case of merger or demerger or amalgamation of Indian companies, it's a very big subject, but only point I would like to bring to your notice is, whenever by virtue of an NCLT order, if the shares are allotted by the company which has to allot as per the NCLT guideline, then Form FCGPR has to be filed within 30 days. And another important point is, there is a school of thought prevailing that by taking an NCLT order and previously a court order to circumvent FEMA regulations is possible. That was the school of thought entertained by several people, but that is all not correct, which has been made very clear in several cases, including the Enforcement Directorate orders approved by tribunal also, that all conditions, entry route, sectoral caps, investment limits and all other conditions have to be complied, even in merger, demerger or amalgamation of Indian companies. Even if such NCLT order is passed and where the permissions have to be obtained or not obtained, that becomes a contravention, and an order cannot prevail over the regulations is what is being made clear. So I think we'll just take a break for 10 minutes and again we'll meet.
Yes, sir.
Uma?
Yes, sir. Yes, sir. I will share the screen, sir. I'll put a break slide, and once you're ready, let me know. We'll stop.
Okay, right.
Sir, if you're ready,
Yes.
I'll just pass back the rights. Sir.
Yeah,
So I'll just give back the rights.
one second. Yeah. Yeah, shall I start?
Yes, sir. Can you put it in slideshow mode, sir, or else do you want to keep it this way?
No, we can keep it in slideshow.
Okay. Yes, sir.
Okay.
Thank you. Yes, sir.
Yeah. So now, friends, let us discuss about this direct investments into an LLP. LLP is having one major issue if the investment is coming with repatriation benefits. As we discussed, if it is with repatriation benefits means where the capital is permitted to be repatriated with the appreciation of the capital. Otherwise, if it is a non-repatriable, it will be treated as a domestic investment. So if the foreign investment coming under non-repatriation is not what we are going to discuss. What we are discussing is investment coming into an LLP from a non-resident with repatriation, then these conditions will apply. The conditions are all non-resident except a citizen or entity incorporated in Pakistan or Bangladesh or foreign portfolio investor or foreign venture capital investor, except these people, rest of all non-residents are permitted to invest. But the eligibility of the LLP is that LLP should be engaged in activities or sectors where 100% automatic route is permitted and there are no FDI linked performance conditions. This is one very important point. A lot of LLPs are not complying with this, and we have seen what is the definition of FDI linked performance condition. And a lot, whenever there is a doubt, before taking the investment, make a representation by the LLP to RBI whether they can accept or RBI is going to give permission. If once RBI permission is required or an RBI says yes, no permission is required, you can access general permission route, then only you can do it, because we have seen a lot of cases in Mumbai, Hyderabad as well as Delhi where these issues have been cropped up and they have been cushioned by Enforcement Directorate because there are FDI linked performance conditions. Why you have accepted investment when the LLP is not eligible to accept, and that becomes a case. And conversion of LLP to a company to LLP or vice versa, that is also permitted. No specific permission is required from RBI, provided the LLP or the company both are not in sectors where 100% automatic route is not permitted, and there are sectors where there are no FDI linked performance conditions. These two things, please keep it in mind whenever an advice is going to be given with respect to conversions. And pricing guidelines, they said it has to be valued by a chartered accountant or a cost accountant they brought in or an approved valuer also in case the capital is going to be acquired by the non-resident or transferred from an existing resident to non-resident. This pricing guideline has to be followed. The method of funding is the money has to come through normal banking channels by way of inward remittance from abroad, or in case of an NRI or OCI, then the amounts can also come from NRE account or FCNRB account. As you all know, NRI and OCI only can open NRE or FCNRB account, and other foreign investors cannot, other than NRIs or OCI, cannot open these two accounts. And then we'll see what are the pricing guidelines. That's what we discussed, and reporting the Form LLP1 to be uploaded through Forms portal of RBI within 30 days from the date of receipt of consideration. Same thing. First, we have to open an entity master. If the entity master is not opened, when the equity investment and the capital is coming, first open an entity master, then obtain a business user registration. Then whenever the capital comes in and the changes are made with respect to the filings with regarding LLP, within 30 days from the date of receipt of consideration, this LLP1 form has to be uploaded in the Forms portal. Then let us look at foreign venture capital investor. Foreign venture capital investor means any company or an entity registered or incorporated outside India and which has come into India and registered with SEBI. Such a registration is given by SEBI to an entity after going through all the fit and proper guidelines, and once it is registered by SEBI, such entity can make investments in India by way of purchase of securities by an Indian company engaged in permitted sectors. I have not written the list here. It is all mostly like biotechnology, IT related to hardware and software development, and nanotechnology, seed research, research and development of new chemical entities, dairy farming, poultry farming, production of biofuel, hotels and convention centers, where the seating capacity is more than 3,000. Likewise, the list is there. Only in those companies they can list. But such companies should not be a listed company at the time of investment by FECA. And units of a venture capital fund or category 1 alternative investment fund, or units of a scheme fund set up by venture capital fund or category 1 alternative investment fund, also this foreign venture capital investor can invest. Equity or equity linked or debt instruments issued by government registered startup entity in any sector. They have given free way to start up. The startup is getting equity from FECI. Yes, they can do it. And irrespective of the sector, the list what are the permitted sectors are not applicable. And what is the actual advantage of foreign venture capital investor investing in an Indian company or an entity is, the unique advantage they have given is an FECA investor can invest or disinvest at any price mutually agreed between the parties. The pricing guidelines are not enforced on foreign venture capital investor. So it is only between the parties to decide, and they can go ahead and complete the deal, and which they need not follow the pricing guidelines. Is one special benefit given to foreign venture capital investor, and he has to bring in all his money from abroad, either by way of inward remittance from abroad, or SEBI, once it is registered, SEBI will give a permission to the foreign venture capital investor to open special non-resident rupee account, which is called as SNRR account, maintained with a bank in India. From that bank also rupee investments he can make. He can also receive rupee investments into that account, and from there he can repatriate subject to payment of taxes. And another advantage they have given to foreign venture capital investor is no reportings need be made, either by the investee company, the company receiving it, or by the foreign venture capital investor. All those things will be made by authorized dealer as per the directions of RBI and SEBI. They monitor the reporting with RBI, and the reporting need not be done by the recipient company. which is receiving investment from foreign venture capital investor. These are all very clear in the non-debt instruments regulations as well as in the FEMA 20R. Then let us look at what are the investments that can be made by non-residents in investment vehicles. So nowadays, now a lot of investment vehicles are coming up. Alternative investment funds or venture capital funds, and venture capital funds set up by alternative investment funds and venture capital funds. Lot of permutation combinations are there. All these things have to get an approval from SEBI to be registered. Post registration, such investment vehicles can accept foreign investment. Such foreign investment can be accepted from any non-resident except a citizen or an entity incorporated in Pakistan or Bangladesh. And the special dispensation they have given to alternative investment funds is they can allot units to non-resident investor against the swap of equity instruments of a special purpose vehicle proposed to be acquired. So this is one extraordinary structure they have permitted, which can be used provided the structure is having an alternative investment fund and such fund wants to acquire a special purpose vehicle, and through special purpose vehicle the swap of capital instruments is permitted. Because of time paucity, I am not getting into it. It's a very big lengthy one, but that structure is there. You can do research on that. They have given that, though, which is normally not permitted in other FEMA regulations with respect to other investment, they have given special permission here. And downstream investment, this alternative investment fund receiving money from non-residents, can they make downstream investments? Yes. Whatever downstream investment that is going to become indirect foreign investment, then indirect foreign investment regulations will apply only if the sponsor, manager or investment manager organized in a form of a company or LLP, if control or management is not with person resident in India, or in case of an individual who is not an Indian resident citizen, then downstream investment regulations will apply. I think you will better appreciate when we get into downstream investment regulation. We'll see there all those things. Then you will also appreciate this. Yeah, as far as investment vehicle is concerned, it is got nothing to do with the capital holding. To decide whether there is an indirect foreign investment regulations applicability, what is looked at is who is the, because any AIF should have a sponsor, or he may be called as a manager or investment manager, whatever is the form they have designed, which is approved by SEBI. If such investment managers, in what form it is the deciding factor. If that is in the form of a company or LLP, then we have to look at the control and management of company or LLP. If such investment manager is an individual, then we have to look at whether he is a person, Indian resident citizen or not. If he is an Indian resident citizen, then downstream investment regulations will not apply. Otherwise, downstream investment regulations will apply. In case the form of the sponsor manager is not an individual or a company or an LLP, and there is some other structure which they have designed, which can be designed because that is an Indian entity. Suppose it is a trust, then SEBI will decide whether such entity is owned and controlled by persons resident in India or not. And that certificate from SEBI also has to be obtained. And then how the investment has to come, mode of funding, the amount of consideration shall be paid from abroad through normal banking channels as involved, or if the investor is an NRI or OCI, FCNRB, or by way of swap of shares of SPV or through SNRR account, all these investments are permitted. The reporting formalities are Form INVI should be uploaded within 30 days of issue of units in Forms portal of RBI, as we have done for a CGPR and LLP form. The same form within 30 days of the issue of units that has to be uploaded. Now let us come to the downstream investment regulations. I think this is very, very important concept. We have to go a little bit background for us to really appreciate what are all these indirect foreign investment regulations. These are, if I just, sorry. What was the position earlier? The position in the FERA period, I'm talking about 90, before 1st June 2000, before FERA used to be there. Under FERA period, there was a press note issued by government, press note 9 of 1999. As per that press note, what was written there was, if any company is having foreign investment and such a company is making a downstream investment in India, then such company should obtain prior permission from Government of India. This was the press note issued during FERA period. When FEMA came on 1/6/2000, Foreign Exchange Management Act 1999, at that time, this concept of downstream investments was totally missed out in FEMA regulations. It was not there anywhere. So several people from 2000 to almost 2005, because there is no controlling regulation for downstream investment, they started making downstream investments. Let us understand what is downstream investment. Downstream investment is a company in India having foreign investment. In turn, that company is investing in another Indian company. This investment in another Indian company is called as downstream investment. Whether that downstream investment will become an indirect foreign investment or not, that concept till 2009 or 2009 on 13th February 2009, that concept was, even if one single share was purchased or one single unit was purchased downstream investment, that used to become an indirect foreign investment. But this concept has created a lot of confusion. Earlier, so many companies, when there was an ambiguous period, they have made downstream investments. Even companies like Tata, Birla, so many people, even banking companies which are having their processing entities or some other operating companies, they also have made downstream investment. Later, government started telling such a type of downstream investment requires permission, as the permission what FIBB in those days was there, that was called as giving a permission for the company from becoming an operating company to operating holding companies. When this much of confusion was going on in the law, on 13th February 2009, they have come out with a press note issued by government, press note 234. They brought in the concept and the law with respect to downstream investment, and they have told what is downstream investment, what is indirect foreign investment, when an approval is required, when approval is not required, and what are all these issues connected with the indirect have been dealt clearly with press note 234. Though government has issued press note 234 on 13th February 2009, and FDI policy, in the policy document makes it clear that if there is any press note issued by the government, though because press note is only the policy decision of the government, it will only become law once a regulation is passed by the regulatory authority. In that case, at that time, it was Reserve Bank of India. Now is Finance Ministry. Unless they come out with the law, till such time that becomes a policy document. Generally, in the law prevails over policy. But as far as FDI policy document is concerned, if you see the policy document, they made it very clear that if there is any press note issued by the government and subsequently it has been not made law by Reserve Bank of India or any concerned regulatory authority, it will become law from the date press note has been issued, unless in the press note itself it is stated as otherwise. In the light of that, press note 234 have become law from 13th February 2009. There were some, I think, some grounds where government and Reserve Bank of India has not accepted, but even that fight went on for quite some time, and finally Reserve Bank of India has accepted Press Note 234, and they brought those things into the law by way of a FEMA notification 278 dated 17th June 2013. So there is a period of almost 4 years. February, the government has come out. RBI agreed finally only on 7th June 2013. While agreeing that, Reserve Bank of India said, if anyone has made any investments prior to 13th February, they need not make any changes. But those who have made any downstream investments as per 13th February, from 13th February till 7th June 2013, they have given a window of 6 months to come to RBI so that everything will be regularized if the investments have complied with the regulations given in 234, coupled with FEMA notification 278. So, but now coming down to the law, let us understand as what is the present position of downstream investments. An Indian entity is permitted to make downstream investment in another Indian entity without prior approval of government RBI, subject to compliance of downstream investment regulations. The Indian entity shall mean an Indian company or an LLP. Only an Indian company or LLP can receive indirect foreign investment. No other entity is permitted. This is also one point we need to be very clear. Okay, what is this downstream investment? Downstream investment means an investment made by an Indian entity or investment vehicle which has foreign investment in the capital instruments or capital of the Indian entity. So downstream investment is a word used several places in the regulations. Indirect foreign investment is used in several places in the regulation, but both the things. Downstream investment speaks about a company making investment in another Indian entity. All downstream investments need not become indirect foreign investments, but all indirect foreign investments are downstream investments. Let us also look at what is indirect foreign investment. Indirect foreign investment means a downstream investment received by an Indian entity from another Indian entity or investment vehicle, where in the case of a company or an LLP which has foreign investment and is not owned or controlled by resident Indian citizen, or is owned or controlled by persons resident outside India. Both are same. Why they have put here is not owned or controlled by resident Indian citizen, or is owned or controlled by persons resident outside India. This is to give away that concept. If a company is owned 50 by residents and 50% by non-resident, even in that scenario, this will become a company owned by foreign investment because it is not owned fully. It has to be more than 51% has to be owned. So this ownership definition and control definition has become very clear, important, and we look at that. In case of an investment vehicle, as we have discussed earlier, it is nothing to do with the capital collected by the investment vehicle. It is only with respect to the sponsor manager or investment manager, who is the person managing. If such investment manager is a company or an entity of an LLP, is not owned or controlled by a resident Indian citizen or controlled by person resident outside India, then it will become an entity controlled by persons resident outside India. In case of an individual, he or she is an Indian citizen. But keeping this aside, a simple way what they want to tell us is, if there is an Indian company or LLP, if that is making investment in another Indian company, we have to first check whether the Indian company which is making investment in another Indian company, is it owned or controlled by persons resident outside India. If it is owned or controlled, then what happens? Then that Indian company making investment in the another Indian company, this another Indian company's receipt of that investment will be called as indirect foreign investment. So let us try to look at it through an example. Let us say there is an Indian entity A, which is in India, and there is an Indian entity B, which is also in India. There are non-resident investors who have invested more than 50% in the Indian entity A, and they are also controlling. In this example, either they are controlling or they are holding more than 50% of the capital. The Indian entity A makes 20% investment in Indian entity B. That 20% received by Indian entity B will be called as indirect foreign investment. Why this is called as indirect foreign investment? Because the company A is owned or controlled by foreign investors. That is more than 50% capital. If it is held by non-resident, that is called as owned by foreign non-resident. Or if it is controlled. What is control? They have given a definition, but more or less a Companies Act control definition is more akin to that. If they are having right to appoint majority of directors, if they are having a right to take management decisions, they are having a right to take policy decisions, or if they are, in case of an LLP, he is having a majority of share, and also he is having a right to appoint majority of designated partners without having powers given to them, and the powers are vested in the non-resident investor having exercisable control more than the domestic designated partner, that will become a company owned by non-resident investors or controlled by non-resident investors. If any one of them is there, either it is owned or controlled, such company will become a foreign owned company. And such company making any investments down the line in any company in India, that is called indirect foreign investment. And there are some regulations which are telling what can be done, what cannot be done. That we will see. So the same definition, the ownership means holding more than 50% beneficial ownership in the equity of the company. In case of LLP, more than 50% of the capital, and having majority profit share. Control means, in case of company, right to appoint majority of directors or to control the management or policy decision by virtue of their shareholding or management rights or shareholders agreement or voting agreement. If any of these things, then the foreign non-resident investors are having control. If they are holding more than 50% beneficial ownership, they are treated as owning the company. If either they are owning or they are controlling, with respect to LLP also having a majority designated partner, such a type of an Indian company for these regulations will be called as a foreign. It's a company making downstream investment, which will be treated as indirect foreign investment. If it is going to be treated as indirect foreign investment, what are all the regulations? We'll see. But why they have put all these regulations? We have certain sectors which are not open for non-residents. If suppose someone from US invests 100% in a software company in India, and that software company in turn invests in another software company, picking up 80% of its equity, that software company in turn invests in another pharmaceutical company, which is acquiring 50%, and in turn that pharmaceutical company, which are all Indian companies, in turn acquiring a company which is into running a casino in India, then the intention of foreign exchange FDI policy sectoral specific guidelines will be defeated, because that non-resident coming into software is going into all these companies and they are becoming indirectly the foreign owners. Then the discussion has come whether even one share, if they are investing, will it become an indirect foreign investment? There the company, government has taken a view. If the company is owned by non-resident, that is more than 50%, or if it is controlled by them, having what we discussed, the definition of control, then only the investments made in the downstream investments made will be treated as indirect foreign investments. If it is, let us say in our earlier example, if the non-residents are only holding less than 50% and they are not having any controlling power, as we discussed in the definition, and they have made, let us say, less than 50%, obviously say 49%, then Indian entity investing in entity B will not be called as a indirect foreign investment, and all the regulations what we are discussing will not apply to that company. This is what they want to bring law through the downstream investment in the NDA regulations. Let us see what are the conditions for this indirect foreign investment. First one is Indian company which has received indirect foreign investment. That means company B which has received indirect foreign investment from Indian company, in our example company A, should comply with entry routes, sectoral caps, pricing guidelines and other FDI linked performance conditions as applicable for foreign investments, except the payment for acquisition of shares which will be made by one Indian company to another Indian company. All these guidelines what we have discussed earlier will also be applicable, though the investment is between two resident Indian companies. This will become an indirect foreign investment. Downstream investment by an LLP into an Indian company which is indirect foreign, always will be writing like this in the law, downstream investment which is indirect foreign investment, or downstream investment which is treated as indirect foreign investment, because all downstream investments will not become indirect foreign investment, but all indirect foreign investments are downstream investment. For it to become an indirect foreign investment, I am again at the cost of repetition, I am repeating, the investing company should have held at least 50% or more capital, or control is with a non-resident investor, then only the downstream investment will become an indirect foreign investment. And this can go to any number of layers. At each layer, this has to be verified. And downstream investment by an LLP into an Indian company which is indirect foreign is only permitted if the Indian company is operating sectors of 100% automatic route and there are no FDI linked performance conditions. Suppose an LLP is having foreign investment, it wants to invest in another Indian company, then that another Indian company where it is proposing to invest, which is called also as investee company, should be in a sector where operating where 100% automatic route is permitted and there are no FDI linked performance conditions. Otherwise, this investment is not permitted and it has to take prior permission from RBI, or if it is directed by RBI, from the government. And indirect foreign investment is permitted in an LLP. Suppose if one LLP is investing in another LLP, or a company is investing in another LLP, then the downstream where the investee LLP also should be operating in 100% automatic route activities, and there should not be any FDI linked performance conditions. Then only it is permitted as per the conditions. And there are some more conditions. The first level Indian company LLP making downstream investment will be responsible for ensuring compliance of FEMA regulations for all its levels of downstream investments. They have not conspicuously added investment vehicles here. These conditions are only made applicable to Indian company and LLP. As far as an alternative investment fund is concerned, since that is controlled more closely by SEBI, they might have not put these conditions, is what is my personal opinion. Sorry, as far as the law is concerned, they are only telling about company and LLP to comply with the conditions mentioned here. The first level Indian company as well as LLP will be responsible. The first level Indian company shall obtain a certificate to this effect that it has complied with all the downstream investment from the statutory auditor on an annual basis. Sir, this is one very important condition, and I humbly submit to all our chartered accountant friends here. This is a separate assignment by itself, and a simple certificate just should not be given, and you have to really spend time on it. Or if you are not having time to go through all these things, you should insist on the company to obtain a certificate from either a law firm or some other person who is doing this, that all the compliances have been done with respect to the downstream investment, and then only the certificate should be issued by statutory auditor. because in several cases in Enforcement Directorate where we are handling, we have seen they're also summoning statutory auditors because the certificate has been issued, which according to me is not fair for them to summon statutory auditor. But that is what they are doing across the India, this Enforcement Directorate. And such compliance of FEMA provisions and statutory auditor certificate shall be mentioned in the director's report, in the annual report of the company, as well as annual report of the LLP. And in case of a qualification report by statutory auditors telling that the compliances have not been done, then it should be immediately intimated to the regional office of Reserve Bank of India by the company or LLP under an acknowledgement. And then immediately RBI wanted this obligation to be met thoroughly by the company as and when there is a qualification done by statutory auditor. And some more conditions are, there has to be a board of directors approval and preferably a shareholders agreement for downstream investments, which are indirect foreign investments. The Indian entity making downstream, which are indirect foreign investments, should only make such investments out of internal accruals only. If suppose the downstream investment is treated as indirect foreign investment, then the company making the downstream investment has to invest only out of its internal accruals, or if the internal accruals are not sufficient, it can bring additional capital from outside India, but it should not use borrowed money from the Indian market for making such investment. That is prohibited. And the law has clarified what is the definition of internal accrual. They said internal accrual means profits transferred to reserve account after payment of taxes. Such internal accruals only are permitted to be made, because this is also one condition they have given in press note 234. Earlier to press note 234, internal accruals were also not allowed. Earlier, I am talking about prior to this 2009, where they came out with press note 234. Prior to that, there were several appeals made, like companies like Microsoft, which have come and set up in India, and the balance sheet is having enough internal accruals, and Microsoft wanted to invest in some other Indian companies in India. Our government refused, totally telling that any further investment, even though you are having internal accrual, has to be brought in from outside India. Such investments only has to be made. Whereas from 234, from 2009, this internal accruals are also permitted. So what is the reporting that has to be done? The Indian entity or investment vehicle making downstream investment in another Indian entity which is treated as indirect foreign investment shall notify Secretariat for Industrial Assistance, DPIIT, Ministry of Commerce, within 30 days of such investment. So here the important point is remittance from the investing entity to the investee company or LLP. The moment money goes, within 30 days, this reporting has to be made to Secretariat for Industrial Assistance, not to RBI. This reporting has to be done within 30 days of remittance of investment, irrespective of whether shares are allotted or not. There has got nothing to do with allotment. The moment the share application money or capital is sent, immediately the reporting has to be done. And in case of Indian investee company receiving the indirect foreign investment, should file Form DI through firm's portal of RBI within 30 days of allotment of shares. And here I would like to bring to your notice, in the law it will be written, the downstream investment, the company making downstream investment should file Form DI. But that is not correct. I think there is a slip over there in the law. If the company which is making investment is filing Form DI, that will become the additional increase of capital in that company, which is not the case. The money is going to another company. That company is getting as an indirect foreign investment. So investee company only should file Form DI through firm's portal of RBI within 30 days of allotment of shares. This is one practical issue. If you look at the law, it will be other way around. And if you get into firm's portal, it will not accept. It has to be done only by the investee company. First, it has to open an entity master. After that, he has to take a business user. then it has to upload that it has received indirect foreign investment. Then only it will be captured in the firm's portal. And if it is done where the Indian entity investing is made, it will not give the correct picture and it will lead to contraventions later on. And there is a special dispensation given that where the downstream investments are made by a banking company under this CDR mechanism, debt restructuring mechanism, will not be considered as indirect foreign investment. If any bank has given a loan, that loan they are converting it into equity, then the bank is having foreign investment. Because it is converting it into equity, will it become a downstream investment of the banking company? No, that is not at all permitted, and that is kept outside the indirect foreign investment regulation, except where the banking company is incorporated in India and it is making downstream investment in their own subsidiaries or joint ventures or associates, then only indirect foreign investment regulation come into picture. Otherwise, they will not come into picture. And then we have to see what is the total foreign investment for downstream investment, because we said it has to, if it is holding more than 50%, because it cannot be in case of a private limited company, it is easy to assess how much are there. If the company is big, it can have various investors who are foreign direct investors. There can be also an FCCBs, foreign currency convertible bonds issued, or there can be ADR, GDRs issued, or there can be, if in case of a listed company, foreign investors might have invested under portfolio investment. Whether we have to take all these things to assess whether more than 50% is held by foreigners, and will it become a company owned by non-resident. For that, we have to calculate how much is the total foreign investment. The guidelines given in this respect are the equity held by non-resident on fully diluted basis has to be taken. Even if there are any convertible instruments, those convertible instruments capital also has to be reckoned, and FCCBs, that foreign currency convertible bonds, which that used to be the norm of the day at that time. A lot of companies have gone and issued FCCBs. The concept of FCCB is nothing but the investor from outside India is having an option like a convertible note, whether to convert into equity or take back the loan with the interest. Those FCCBs have not really helped the Indian sector. Later, no company is going in a big way. This was the fashion and of the day during 2005 to 2010. Such FCCBs will not be reckoned. ADR, GDRs, which are having underlying shares in India, also will not have, which are issued with respect to debt, not for equity, will not be reckoned as a foreign investment. And foreign investment has to be calculated at every stage of the investment. In case of multi-layered downstream investment, in respect of listed company having portfolio investors, the position of the non-resident investors through portfolio, through stock exchange, as on 31st March of the previous year has to be considered. This becomes the total of the foreign investment for the calculation purpose. So with this, we have come to an end with respect to downstream investment. And if you are having, that is why I am trying to keep at least more than 20 minutes for question answers. I think the organizers have asked me whether the people can ask question while the session is going on. I requested them to keep everything at the end. So once we finish this one, you can start asking any questions with respect to downstream investment or any matter, any point which we have discussed. Now let us look at, till now we have looked at downstream investments into companies, into LLP, into foreign venture capital investor, or into investment vehicles and downstream investment. Let us also look at the portfolio investment. Foreign portfolio investment is a registered foreign portfolio investor, registered with whom? SEBI. A foreign portfolio investor has to be registered with SEBI. But here also, though you may all know, but let me again tell you, the Indian stock markets are only open to non-resident Indians, overseas citizen of India, are permitted investors like foreign portfolio investors or some sovereign wealth funds which are also registered by SEBI as investors. Only they can come and invest. These foreign portfolio investors are earlier called as foreign institutional investors. Other than these people, no other investor is permitted to come into Indian stock exchange market. Like suppose someone who is a foreign American citizen of American origin, he cannot come and directly buy the stock in Indian stock exchange market. As per the FEMA guidelines, it is not permitted. But the reverse of it, because you may also be going through that LRS regulations in some other session. In that LRS, we from India can acquire shares of, let us say, Apple company in US directly by opening a demat account in US, and we can purchase the Apple share subject to that LRS limit. Likewise, a foreign citizen of foreign origin cannot come and buy the shares in India. Indian shares in the stock exchange market can only be done by NRIs, OCIs, and another big investor who is permitted is foreign portfolio investor. Who is that foreign portfolio investor? He has to be registered with SEBI. The SEBI has delegated that power to authorized dealers who can act as the persons to register the foreign portfolio investors now, and they need not go to SEBI, and they will be doing it as per the directions of SEBI. They can register a foreign portfolio as an investor, and there are various guidelines who can invest, how they can invest, what they can do, what they cannot do, who can become shareholders there, whether NRIs can hold the shareholding as a foreign portfolio investor. These are all issues discussed, debated in SEBI guidelines. As far as FEMA is concerned, if a foreign portfolio investor is registered with SEBI or the DP, mean authorized dealer of DP, then he can purchase shares in the Indian share market, which of either listed Indian companies or to be listed Indian companies. Also, he can buy. What is the limit they have put for individual FPI? An individual FPI or an investor group can hold less than 10%. All the related parties of the FPI will become an investor group. All such investor group put together, they can buy in the market only up to less than 10%. It has to be 9.999. It cannot be up to 10%. Once it becomes 10%, becomes FDI. It cannot be FPI. Of the total equity capital on fully diluted basis, and accordingly for each series of debentures, preference shares, share warrant, for everything it is up to less than 10%. What is the aggregate limit, sir? The aggregate limit for all FPIs put together shall be 24%. Okay, then the next question is, who is going to control all this 10%, 24%? Is it by the investor? No. Every FPI is obligated as per SEBI to only go through one registered broker for purchase of shares, and he has to go through one bank account, and all these things are monitored and linked to the Reserve Bank of India, NSDL and CSDL will be monitoring that, and that banker who is acting as his broker, that broker has to control and see that this 10% limit is not reached. And also NSDL and CSDL are now operating. Previously Reserve Bank of India used to operate. That all FPAs put together should not cross that 24%. That also is done on a very big basis, where the trigger is issued whenever it is reaching 22%. The trigger is sent to all the brokers, and then the purchases are controlled, and they will see to it it doesn't cross more than 24%. But the 24% total limit can be increased by the individual company up to the sectoral cap with the approval of the board and its general body. So the aggregate FPI limit, that is what I mean, the 24% is what the law is giving. All FPIs put together in one company through market they can buy. But if company says, I want to increase the limit from 24, then they can increase up to the sectoral cap. The sectoral cap is 100%, subject to listing requirement. They can increase it up to 74% or whatever is the percentage is suitable for them. That requires board and general body permission. But suppose there is an FDI prohibited sector where the Indian company is into that, like there is one cigarette manufacturer like ITC, which is FDI prohibited sector. But in ITC, foreign portfolio investor can invest up to aggregate limit of 24 up to individual limit of 10%. But what has happened with these limits recently? On 1/4/2020, the aggregate limit for all companies was taken to the sectoral cap. They have jacked it up to the sectoral cap for all the listed companies by passing one I think they have passed one APDR circular, and also SEBI has passed its own circular. And from 1st April 2020, they said all companies sectoral cap, all companies FPI limit will be taken to the sectoral cap. This they have done sometime on the, I think if I remember right, sometime around December 2019 or January 2020. And they have given option to the companies, because if the limit has been taken, though earlier you have not increased from 24% to, let's say, 74% through board resolution or special resolution, the company default they have increased it to sectoral cap. And companies were given an option, you decrease the threshold limit to 24, 49 or 74 as they deem fit through board resolution and special resolution before 31st March. Having done that, if suppose companies again they realize, or if they wanted to decrease the increased limit, they were given only one chance to either decrease the increased limit. But once that option is exercised, everything has been freezed and frozen, and the limits are taken to the sectoral cap, or to the extent they have decreased or subsequently increased. And now if any FPI, if it has breached the limit of 10% and it acquired more than 10% by whatever reason, RBI has said they were given a window of 5 trading days from the date of settlement which caused the breach. You rectify the position and you offload, disinvest and come back to less than 9.99%. If they do within those 5 trading days, it will not be construed as a contravention and there will not be any penalties levied. But if they breach that and they do not rectify within 5 days, then the entire investment made by FPI will be treated as FDI. And also the foreign portfolio investor will not be permitted to make future portfolio investment. That FDI investment will only comply. All other FDI guidelines will come into application, subject to also compounding by Reserve Bank of India. So there are some other investors other than these foreign portfolio investors like sovereign wealth funds, multilateral entities, etc. They also will be reckoned as FPI for 10%. And if suppose such sovereign wealth funds, like let us take Singapore. Singapore is having a sovereign wealth fund like Temasek. They also have another fund, GIC. When GIC, Temasek, both are investing, the both will be clubbed for this 10% limit unless they take a special permission from the central government. Otherwise, all these like the major mega sovereign fund investors are from Abu Dhabi Investment Authority as well as Russell Kema Investment Authority, and there are a lot of from Norwegian investment funds, several foreign wealth funds. Unless they have taken a special permission from the central government, they all will be clubbed and they have to fall within the 10% of acquisition. What are the pricing guidelines for them to acquire the shares through public offer? Not less than through the price offered to the residents, and if it is a private offer, price not less than SEBI guideline or fair market valuation done by a chartered accountant or merchant banker or cost accountant. Other benefits for FPI are they can undertake short selling, lending, borrowing of securities as per SEBI guideline, and all investments have to come through normal banking channels and or through SNRR account permitted to be opened by SEBI. So now let us look at government approval. We have come to the end. We have another, I think, 30 minutes for question and answers if you have any. And the government approval route, what all we discussed under the approval route, if any investment, if any condition is not complied, then you have to make an application to government approval route. The procedure for applying and the detailed forms what have to be submitted is given in their link. And there you have to submit. Previously we used to submit it to Foreign Investment Promotion Board, that has been dispensed with. And now what is there is Foreign Investment Facilitation Portal, and in that they are keeping one FDI expert from the reserve, from Government of India, and he is vetting all the application and forwarding it to the relevant ministries and getting the permission. But previously for pharma sector, permissions used to come in 2 months or 3 months time, and now a lot of sector permissions are taking more than 2 years. I don't know, I think once this FIFP has come into picture, there is enormous delays in getting permissions from Government of India, especially with respect under this government. So I think, friends, if you have any questions, we'll get into question answer mode. Thank you.
Yes, sir. I will share my screen. We have some 15 to 20 questions. I'll
Okay.
just display it on my screen. Is my Excel sheet visible? Yeah, from first one, from here.
Yeah, the first question is, any specific challenges in FDI and ODI happening under share exchange? Indian company issuing shares to overseas company shareholders as part of share swap agreement. Any specific challenges in FDI and ODI happening under share exchange? Indian company issuing shares to overseas company shareholders as part? No, actually, what is to be there are no much challenges, but the only challenge is, whenever we are talking about a swap, an Indian company is making outbound investment, that is, it is acquiring the shares of a foreign company. In lieu of the consideration, Indian company is allotting shares of its Indian company shares to the foreign investors. The challenges there are your FDI investment, because you are getting in lieu of remittance, inward remittance or physical cash into the company, you are allotting shares. That valuation has to be taken care. And in case of a swap, if the amount involved is more than $5 million, the valuation has to be done by an investment banker outside India, and the valuation of the Indian shares have to be done by a merchant banker in India. And you have to comply with all FDI guidelines, you have to comply with all ODI guidelines. Only challenge, another challenge is, if in that company which the ODI acquisition is happening, if that company is having already an Indian shareholder there, either a company or a person, such structure is not permitted without the prior permission of RBI. This is one major challenge. Let me repeat that again. If any Indian company is making an investment in foreign company, and again that foreign company shareholders are coming into Indian company, but when the Indian company is acquiring shares, if there is a foreign Indian shareholder outside India in the company, the ODI, FDI regulations will come into picture. That is one challenge. One has to be very careful. So what the government is telling is, it should not be designed in a round-tripping manner, where there is a Indian investor in foreign company, such a foreign company again investing in India is not permitted. That structure only you have to take care. Otherwise, all complaints of FDI and ODI and valuation is one challenge. It has to be done only by the investment banker. If these things are taken care, ODI guidelines are followed, FDI guidelines are followed, then there should not be any other major challenge other than complying with the regulations. Next one is, I think, electronic manufacturing, doing manufacturing for various sectors like healthcare. I think healthcare, defense. If they supply few electronic sub-assemblies to defense and ISRO, does such private company limited comes under automatic route or approval route? Confusion is which sector? Component suppliers to sensitive sector does come under automatic or approval? Your thoughts, please. Very important question. So first and foremost thing is supplier of equipment to defense sector or for making of any satellites or any other sector which is not open for private sector. This electronic or any other manufacturer, if he is supplying, per se, he will not become such supplier unless only in defense. They made it very clear in the defense there are certain components which have to be supplied and also maintained by them, and they will be brought under the definition of defense sector. Only those people come within that. All others are not coming, will not come under defense sector or ISRO sector. Let us take in the defense, the army, Indian army purchases several vehicles from Maruti, several vehicles from Mahindra, and Mahindra and Maruti will not become a defense company. But at the same time, there can be one software company or a company which is manufacturing satellite equipment, which is supplying it to defense. And not only supplying, they have to manage and maintain and run the equipment. Such type of companies, in the order given itself, there it will be made clear that you will form part of the defense sector or whichever sector. In such type of companies, foreign investment will not be permitted depending on the sectors where they are getting into. Is it clear, sir? I think whoever has asked that question, that is, you have to look at the contract for what has been given by defense. Defense is giving contract to several people. All contractors, all suppliers will not become defense. Only in the contract, if it is mentioned clearly that you will be forming part of the defense sector, only they will become. That is what has been clarified by Reserve Bank of India. Next question is, if the investment for owning brands are permitted under FEMA, and can you highlight investment conditions through gift city entities? If the investment for owning brands are permitted, yes, there is a permission given, where previously for royalties and other things they used to keep limits and other things which have been now totally removed, and the brand can be acquired by an Indian company. But investment conditions through gift city entities, so these two things are different. Number one is, can you acquire a brand, international brand? Yes. But are there any limits in that? No. You go ahead. It is a current account transaction. Long back, 10 years back, brand limits used to be there. For royalty limits used to be there. Now everything is under the agreement and the valuation of the brand. If the valuation of the brand is properly done, that can be acquired. That is one question. Next question is investment conditions through gift cities entities. As far as gift city is concerned, it is an international financial services zone identified by government. They are telling that it will be treated as a place outside India, but all investments into that should go through outbound investment regulations. A prior permission has to be obtained from the gift city authority for making the investment. But gift city, except the for 120 compliances, the additional compliance what you have to take is, you have to take first permission from the gift city authority for you to approach RBI practically. But I have seen several companies, including financial services sector, where like if we are also going through the outbound investment regulations. If you want to enter into financial services sector, regulation 7 of FEMA 120 has to be complied. That regulation 7 of 120 says 4 conditions. One condition is, in the financial service sector, you should have made profits last 3 years, complied with the prudential norms, and you should have obtained permission from both the regulator within India and the host country. And the fourth one is, you should have complied with all the filing compliances with respect to the investments. I mean, the regulator, whatever he is imposing, all these things, there are several instances where gift city has given exemption. Other than that, this is not there. The next thing is, if such gift city exemption is obtained and a gift city entity is set up, from there you want to acquire a brand, it is as good as acquiring a brand by setting up a company outside India. And you can acquire and you can make the payments. But as far as the tax benefits are concerned, I still have several doubts there. You cannot get the tax exemption as if you are going out of India. The same thing will be applicable even though you are in the gift city. Next one, why immovable property is non-debt instrument? Very good question, sir. I think even I want to ask that question very loudly. Why government has made an immovable property as a non-debt instrument? What is the meaning behind that? I have not seen any meaning behind that, except I take the liberty and permission from the organizer to say that there was a fight going on between RBI and Government of India, especially Ministry of Finance. Reserve Bank of India and Ministry of Finance. Reserve Bank of India was telling no to several things. We have seen the downstream investments. The press note was given in 2009, finally agreed by RBI in 2013. And they want, what they have done finally in 2015, government has taken a decision that anything connected with equity instrument will be controlled by government, not by RBI. This is a very drastic step. You want to see, you go to FEMA Act, go to section 6.3, and you see that it has been removed in 2015. But they have not passed, they have not taken any further steps to notify that, and that tussle was going on. And finally, the government said all these non-debt instruments will take. While taking that, they also wanted to take immovable property regulations, and they have put it in the rules. Otherwise, that would have gone into Reserve Bank of India domain. This is what is more an informal reply I am giving, but otherwise, all our chartered accountants will ask on what basis they said non-debt instrument is an immovable property. But having said that, that is the law, we have to comply, there is no other reason. I cannot say any other reason why they have put it immovable property in non-debt instruments. Next one is private limited into design and supply of sub-assembly for fittings into satellite. The fact is, company is not producing satellite, but supply sub-assembly that gets fit into such satellite. Does this company come under automatic rule, given they are just sub-assembly? Sir, the same answer what I told. What is the contract? Whether the contract is given by a private party who is into satellite, then that private, there are very few companies in India which are manufacturing satellites with the permission of Government of India. Such companies, if they are giving any subcontract, it is obligated on the part of that company to say, depending upon the scope of work of the contract, whether they come within the scope of this satellite manufacturing or not. According to me, that mostly depends upon the service contract associated with the total contract given to the company. If that is there, then that it becomes satellite company. Otherwise, it is under automatic rule. Your supply assembly to either satellite company or to defense company. You will not become a company of defense, or you will not company of satellite. Most important point is, please look into the agreement. In that agreement, if it is not there, my advice would be, ask the company which has given the agreement to you whether you will be brought under the satellite assembly group. They will be telling no, according to me, most of the companies, unless there is a strategic defense equipment only, they are bringing those companies into defense. And likewise in the satellite also, if it is strategically important, they will be telling, then you cannot accept foreign investment and you have to go through the government permission. Next, will OCI treated on par with NRI? Absolutely is treated on par with NRI. Almost everywhere, except that unless he is having an OCI card, after this non-debt instrument regulations have come into picture, without having an OCI card issued to that OCI, he cannot make any investments in India. Other than that, they are on par with NRI. For NRI need not have an NRI card, OCI should have a OCI card. Without that card, he will not become an eligible person to invest in any of the avenues in India. In case of consideration for issue of shares as paid while incorporating a company, in case the consideration for issue of shares as paid while incorporating the company, the shares were not issued within 60 days. How do we proceed? In case of consideration issues as paid while incorporating company, issue consideration for issue of shares as paid or not paid, I am not able to understand. I was paid while incorporating a company and the shares are not issued within 60 days. So at the time of incorporation, there are some shares which will be subscribing to the memorandum and articles. Whether if the question is relating to that, that is the only exception area. After the incorporation and the allotment of shares, the money can come into company within 60 days. If the question is the incorporation has happened and the money has been paid after post incorporation and they have not allotted shares within 60 days, if it is repatriable shares, then it is a contravention. Whether it is repatriable or non-repatriable, non-allotment of shares within 60 days is a contravention under anyway Companies Act. As far as FEMA is concerned, if you have not allotted within 60 days, an application has to be made to Reserve Bank of India that we have not issued shares, and then seeking them the permission. If you want to allot shares or you want to refund the money, you have to seek permission from RBI. In both the cases, RBI will give permission subject to compounding. And once the compounding is done, whatever is the penalty levied, that has to be paid. The next question is net asset value method, an internationally accepted methodology for compliance with pricing guidelines. Very interesting question, sir. Very good. The net assets method per se cannot be told as not internationally accepted methodology at all. The valuation methodology is dependent on various factors. What type of an asset you are valuing, what type of an assets are there in the pool of the assets within the company, then a methodology has to be designed by the valuer. It cannot be that all shares will be valued only at a discounted method, or all shares will be valued at a net assets method. There are some companies where net asset value method is the only method that has to be used as per the internationally accepted methodology. In the light of that, it cannot be said that net asset method is not an internationally accepted method. But having said that, which method is adopted for which company is the obligation and responsibility of the valuer. He has to also give in the valuation report on what basis, which method he is taking. But with due respects, we are seeing several valuation reports where they are telling the same thing. There are 3 methods. Out of these 3 methods, one method we are taking, we are trying to equate it to the price market. It's all good. But if you are not giving enough reasoning why a particular method is used, that is not correct. But coming back to your original question, is it an internationally accepted methodology? According to me, I have read in several books written by Damodaran, where it has been identified as the most appropriate method for certain companies which are into business, like where they are setting up, let's say, in our earlier examples, suppose a company is manufacturing a satellite. Satellite manufacturing, let us take 18 years or 8 years or 7 years, then that net asset value method is the correct method. Yes, sir. The next one is, will investments from Macau and Hong Kong be treated as investment from countries with the land borders are shared? Yes, sir. Because Macau and Hong Kong has become part and parcel of China, it will be treated as Hong Kong as well as Macau as my investments coming from China only. Because there are several, to the best of my knowledge, several representations made by Reserve Bank of India with respect to international treaty agreements, with respect to sharing of details, information from Hong Kong to India has not been accepted. But as far as your question is concerned, it will be treated as a land border country. Next, sir, in case of a rights issue, if the rights issue offer has been rejected by the resident investor, can the non-resident investor invest at a price at which the offer was made? Or is there a requirement to follow pricing? Yes, sir. Any rights renounced or rejected by resident Indian and picked up by non-resident, the pricing guidelines will come into picture. If only a non-resident is renouncing shares to another non-resident, then the law was silent. We can safely assume that this pricing guidelines will come if a person resident in India is either renouncing or rejecting. Such rejected shares are being allotted to non-resident as a renouncement, then these things will come into picture. If suppose there is no connection between person resident in India and the non-resident, and non-resident is acquiring shares without any link to rights issue, then it is a normal issue going on. You have to go through pricing guidelines. In both the instances, pricing guidelines are applicable. Next, upon filing of returns in firm's portal, if the AD bankers take time beyond the stipulated deadline of the RBI, what will be the implication on the resident? Very good question, sir. One thing which we have to remember is, as far as FEMA guidelines are concerned, authorized dealer is our agent. Any contravention done by authorized dealer is also penalizable on the company or the person conducting transaction. So if there is any delay made by authorized dealer, that delay should be made very clear in the compounding application. But Reserve Bank of India, even though delay made by authorized dealer, they still ask the company to come for compounding. In the compounding, this can be placed before them, where the penalty will be substantially reduced, but it cannot become as if the authorized dealer has done a mistake. There is no compounding, is not the scenario. LLP pricing guidelines will be based on profit proportion to capital contribution. Since generally LLPs can have different capital contribution and profit sharing ratio regarding indirect foreign investment, will the regulations be applicable even if the Indian entity is a JV, even though more than 50% capital is held by NRIs? Sir, LLP pricing guidelines, will it be based on the profit proportion to the capital contribution? Yes. Can have different capital contribution and profit sharing. It is all based on the profit sharing ratio only. The valuation will be done, and valuation is also main. That is the method Reserve Bank of India also is accepting. It is nothing to do with the capital contribution. Mostly, unless the capital contribution takes a significant portion as per the agreement, otherwise it is always profit sharing ratio only has to be reckoned for valuing and LLP pricing guidelines. And the next question is regarding indirect foreign investment. Will the regulations be applicable even if the Indian entity is a JV, even though more than 50% capital is held by NRIs? Yeah, again I am trying to say the 50% capital is held by NRIs under repatriation. Then that will become a foreign investment. If it is a foreign investment, yes, if such LLP Indian entity is making any downstream investment, that will become as that will be treated as an indirect foreign investment. Definitely. Next, sir, can an OCI acquire equity shares in an unlisted private company on repatriation basis? Yes, he can acquire, provided all these rules are what we have discussed. If they are all complied with, yes, an unlisted private company, an overseas citizen of India, can acquire. Suppose he wants to acquire under non-repatriation basis, that is, all these regulations what we have discussed will not apply, and only if he wants to acquire under repatriation basis, yes, he can acquire. Yes, the private limited company has to comply with all the regulations. Next, will the provisions of downstream investment be triggered if the Indian entity in which more than 50% shareholding is held by persons resident outside India acquires another entity by way of a secondary transfer? Will this be treated as indirect foreign investment considering the investing company does not receive any funds from the new investor? So the source of acquisition is not important. The acquisition itself per se will trigger the indirect foreign investment regulations. What I have understood in the question is, a company in India having foreign investment more than 50% is acquiring another company not by sending money to that company, but by way another structure, either by way of a swap or by any other methodology. But ultimately, it is acquiring the equity of that company. Yes, all these indirect investment regulations will apply, the pricing guidelines will apply, everything will apply. And if such a secondary transfer, I have not understood what they mean by secondary transfer. If that secondary transfer is not in compliance with the pricing guideline or not in compliance with the sectoral specific and all other conditions discussed, then that will become a contravention there. But now coming back to your question, yes, the indirect foreign investment regulations will trigger, it will be applicable. Next, if indirect investment is not treated as downstream, we still need to intimate DPIIT and file DA with the, if it is not an indirect investment, no filing is required. No filing is required. But only thing you have to remember is, as a statutory auditor, you have to be very clear to assess whether it is indirect foreign investment or not, based on the regulations what we have seen. If it is not, no intimation is required. As I told earlier, if suppose the control is not there and the investment is less than 50, let us say 49%, then downstream investments are not treated as indirect foreign investment, and no intimation or reporting is not required at all. Only when it is indirect foreign investment is DPIIT as well as Form DI comes into picture. Who will keep track of FPI 1024 in the Indian company? Yes, sir. All the brokers registered by SEBI and also NSDL and CSDL. It's a huge exercise that goes on. Everything will be keeping track there. They issue trigger points. They'll be keep taking care. But FPI has to take care of his 10%. He should not invest more than 10%. Generally, these brokers, they control FPI accounts also. They will not cross. And these all now coming back to your question. It is not Indian company. That is all handled by the brokers who are acquiring shares on behalf of FPIs. Because company will not be knowing at all and company need not maintain that. Can FPI invest into unlisted private limited company? Yes, it can invest into to be listed company, which will be unlisted company. Clarify the difference between downstream investment by an Indian company versus investment company making investment. What is the difference? Okay. Downstream investment is a word used by any investment made by an Indian company into another Indian company. The word used is downstream investment. So in your question, if the investment company is making investment, you are not told what is that investment. Let us think that investment company is making investment in shares of another company. That is also downstream investment. Whatever company making investment is called downstream investment. Whether such downstream investment will become indirect foreign investment or not, we have to verify all those regulations and see whether it is indirectly foreign investment or not. So again, I am repeating, all downstream investments will not become indirect foreign investments. All indirect foreign investments are downstream investments. Next, sir, can clarify difference? Yes, sir. That's it. So I
the
think
questions are, let me just check it.
Yeah.
The last question. So this last question.
Yeah.
This one, the last one.
Can an NRI director provide loan to an Indian company? Will it come within the purview of ECB? Yes. An NRI director cannot give a loan to an Indian company. Popular mistake committed. If an NRI, if the person is a resident outside India, your Companies Act may give you permission to accept loan from a director, but under the provisions of FEMA, that is not permitted. Only permission that is given with respect to an NRI director. Any NRI need not be a director are not given any special dispensation. That is not permitted. Only if there is a deposits going to be accepted in public offer, then only they are permitted to contribute to the deposits. Otherwise, any NRI director giving a loan to company, please advise. Nowadays, Enforcement Directorate is picking up all these things across the board, because happily they are sitting in the office, taking the balance sheet, looking at it, and filing the issuing the summons. That is not permitted. And as per you, please verify regulation and notification 3 capital R. All these guidelines are there, not permitted. Okay, sir. Any other?
Yeah, we are done with the questions, sir. Thank you so much, sir. Ma'am, over to you.
Yeah, thank you.
Thank you, sir. Thank you. So thank you, sir. It was such a very enlightening session. So I think this is one area, especially with respect to FEMA, I think we get lots of queries from the client. So I think starting from what is an foreign investment, what is meant by downstream investment, and what are the conditions or what are the sectors that we prohibited from doing in foreign investment. And again, this is another doubt which people have. It is who can invest in India. So this again explaining with help of illustration, especially the downstream investment, was really wonderful, sir. And the conditions and how to calculate the total foreign investment portfolio investments. So I'm sure all the members would have a wonderful time. It was such an enlightening session, and I wish, and again, taking up so many queries. I think almost we ran out of time taking all the queries and patiently answering all the queries. It was such a great thing of you, sir. And we expect you to take a session physically also at SIRC soon. So thank you so much, sir. Thank you for this wonderful session.
Yeah, thank you very much, and thank you everyone. Thank you all of you for your patient hearing. Thanks a lot.
Thank you, sir. Thank you so much.
Thank you. Thank you so much. Bye.
Bye bye. என்ன சொல்றோம்?